All right, good morning, everybody. Today is the 11th of November, and we're going to pick up from where we have left off. We're right on track with the syllabus and the schedule. If anything, I do try to defer due dates in order to allow some more time to, it's hopefully you find it to be accommodative in the sense of pushing due dates back. Chapter 10 was not a particularly lengthy chapter, so I did not make an adjustment to this sort of uniform syllabus that was created. I do not create the syllabus for this course, but I will modify the due dates when necessary. And I'm going to do that for chapter 11 because chapter 11 is a fairly lengthy chapter. And so I pushed the due date for the quiz and the discussion, the initial discussion post to next week, the 21st, which is going to be on Friday, and then the due date for the homework on the 23rd. So there's really nothing to do this week at all, other than just reading and sort of following along and going from there. I know this is a busy course. I've said that a number of times before. There's a lot going on here, and so I want to make sure that everyone has as much time as possible to work on some of these issues. Before we come up with a third exam, obviously we got a couple chapters after this one. I don't really like to look that much ahead just because I think we have a lot to do. And sometimes I think we can overload ourselves with thinking about what's coming. But you can look ahead if you really want to know what's coming. Maybe that's a good thing. Maybe I'm wrong. Maybe it's a good thing. But I have not yet established a due date for chapter 13 and chapter 18 and leading into the exam. Let's just see how things go. I do like to keep exams on the due dates scheduled. I do know a lot of people will try to work out their daily lives or their semester-wide planning around exams and whatnot. And some of our students travel, and I get that, and whatnot. So I do try to accommodate people by at least keeping those exam due dates constant. Okay. All right. So we're in chapter 11. What is chapter 11 dealing with? Well, it's really a continuation of chapter 10. Remember, what we're doing is we're working our way down the balance sheet here. So we're on the left side of the balance sheet, so the metaphorical left side. Back in the day when a lot of, and still even to this day, if you get physical copies of annual reports, you'll see the balance sheets opening up, assets on the left side, liabilities and shareholders' equity on the right side. So a lot of us can't resist, talking about the asset side as being the left side of the balance sheet. But it doesn't matter how the presentation goes, whether it's top to bottom or left to right, it doesn't really make any difference. We are talking about the asset side of the balance sheet. But in chapter 10, we talked a lot about acquisition of assets, how we record them in terms of historical cost, how they're exchanged, and where typically fair market value, not book value, really sort of dictates the accounting treatment for that. Here, we're going to talk about, well, first of all, utilizing the assets, and that's pretty much a lot of what we're going to be doing today, and maybe into Thursday as well, and then we're going to sort of get into disposition. Remember, the term disposition really refers to anytime an asset leaves the balance sheet for whatever reason, whether it's being sold, whether it's destroyed, through like a fire or natural disaster, whether it's stolen, whatever the case might be. The firm is disposing of the asset. It has to remove that asset from the balance sheet. And we talked a little bit about this because it was sort of necessary in the case of acquisitions, because a lot of times we'll exchange one asset for another, or we'll trade an asset in, right? Particularly vehicles. I think we're all familiar with the idea of trading vehicles in. But the same goes with businesses where maybe it's not a car so much. It could be a car, but it could be a delivery truck, it could be an 18-wheeler, it could be a lot of different types of things. But the point is, though, you're taking the asset off the books and also any accumulated appreciation as well, that contra asset, which accompanies that and is tagged directly to that particular asset. Okay, so we need to be reminded that those two will go together. So we're going to talk about really a couple things today. Hopefully some of this, the good news is some of this may be a bit of review from Principles 1, 2110, where we talked about depreciation, which is really sort of the main theme of where we're going to go today. As we get going a little bit deeper, we'll talk more about depletion and amortization and how we sort of account for these in terms of the disposing of these assets, as well as the use of the assets while they're in service. So let's talk about this. So PP&E intangibles, utilization, and disposition. Not so much disposition today, but certainly utilization and how we account for the value of these assets over time. All right, so we talk about PP&E and also intangibles, which again was sort of the main focus of chapter 10. we're talking about assets that have future benefits, or what we call future service value, usually for several years, which is why they're long-term assets in the first place. Sometimes you may colloquially call them fixed assets, not because they're fixed in place, because an 18-wheeler or a 747 is not fixed in place, but it's fixed on a balance sheet for a period of time, usually over a year. So we call these long-term assets that fit into this broader category of PP&E, and they have future service value. And remember, the definition of any asset is some resource that's owned or controlled as a result of past transactions and which have future service value. That's the sort of the textbook definition of what an asset is, particularly under the GAAP framework as to how we define these. And we're also saying that these assets are acquired to be used as part of revenue generating operations. Now, this is important because there are occasions in which some assets are taken out of service for whatever reason. And the one part of the economy that sort of strikes me as being particularly relevant to mention here is that of oil drilling, where if the price of oil falls really, really low, sometimes drillers will simply take their rigs out of service and they'll put them in big warehouses and they'll simply store them. And they're not really generating revenue at all because they're sort of sitting there. And so, but they're not really being placed in service. And so you have to have service value in order to be counted as an asset. You can always bring them back and all that, but that's a little bit beyond what we're doing here. And again, oil and gas accounting it's its whole separate universe of weirdness. So if you're really interested in that, maybe some of you are. There are other courses you can take elsewhere that will sort of flesh that a little bit more. So when we talk about how we book these asset acquisition costs should be allocated to periods benefited by their use. Let's talk a bit about this because this is really interesting, and it sort of goes to the theoretical definition of what an asset is in the first place, particularly a long-term asset. These are essentially prepaid items. And remember, prepaids are deferred items. What's being deferred? What's being deferred is the future service value or the future benefits. So we buy a building or a piece of equipment or a long-term vehicle or a machine, whatever the case might be, whatever the case might be, and we're going to spread the cost over its useful life. In other words, we're paying ahead of time for something that's going to give us future value, and so we're going to allocate that cost over time. And in the case of something that's very tangible, like a machine or a vehicle, we're going to depreciate it. And so depreciation is one method by which we do it. Now, cost allocation generally takes three forms, what we call DDA, depreciation, inflation, and amortization. But these are different because the assets to which these allocation methods apply are quite different. Depreciation is the one that I think most of us know about. That's the idea. We buy a piece of machinery, we buy a computer, right? And it's got a service life of, 3 years, and we depreciate that value over time. We book out the cost of the computer, and we take the value of that computer down over time, okay? That doesn't mean the computer can't be lost or destroyed or whatever, but we're going to allocate that cost of depreciation. Or things like fixtures and furniture and whatnot. This is not something that, it's a pretty broad net that we're casting. Depletion really only but these are assets that would qualify as depreciation. When we talk about depletion, we're talking about natural resources, and we're talking about things like minerals primarily, but also timber in that regard. So depletion relates to the idea of bringing down the value of that particular asset. And depletion accounting, again, kind of sort of suggests oil and gas accounting. And I do not hold myself out as an expert on oil and gas. I can only tell you my experience in the tax realm meant that I had to do a lot of study. I really did, because it's a whole separate area. But and we'll talk more about depletion. We will get to it because it has definite financial accounting ramifications. In amortization, we covered a bit in 2110 or Principles 1, where we talked about intangible assets, things like patents. And you'll amortize those if they have a finite life, like a patent, for instance, a 20-year patent. Well, that is pretty simple, and we usually appreciate those on a straight line basis. And we're going to come back to the idea of straight line once again. Hopefully that's not a new concept to anyone here. Straight line is simply taking the even amount every year for however long the useful life of that particular asset is. Whether it's depreciation in the case of straight line, or whether it's amortization in the case of an intangible asset like a patent or something of that nature. So these assets are essentially prepaid, and what we're doing is we're allocating the cost over time. And by the way, one of the things that I know that I talk a lot about in financial accounting generally is the idea that depreciation is not a means necessarily of trying to get an asset down to its market value. And I think this is probably among lay people not well understood, frankly. And it's the idea if you buy a building for $2 million and you're depreciating that value over, I don't know, 30 years or whatever, and the building is now worth 200,000 at the end of that at the end of some time period. Does that mean you're depreciating down to 200,000? That's what that's worth? Not really. It's an allocation method, and again, that is not fair market value because we do not typically put things on the books at fair market value, except when they're acquired, because that is theoretically their fair market value. There are some assets like liquid securities that we will step up and revalue with market value accounting, but those are cases in which these assets have very quotable asset prices and whatnot, and we're not really talking about that here. So when we talk about straight line, we're talking about an even amount over time, and so it's allocated not on an accelerated basis or not on any kind of other basis but that. Okay, so that's the process of cost allocation in general terms. And when we talk about allocation, so here's an example where a company purchases a used truck for $8,200 to deliver products. The company estimates at 5 years from the acquisition date. The truck will be sold for $2,200. And $2,200 is what we would call a residual value, sometimes called salvage value. I know the term residual is sort of replaced the term salvage value because salvage sort of suggests that it's junk, it's on its way to the junkyard. Not really. I mean, it's just simply a residual value. And by the way, that term is used a lot in the leasing world. And I had some experience in that where some asset at the end of some time period is not useless, but it's not quite the original fair market value from which became the book value at the time of the origination of the lease. Just that there's some value that remains, and we're going to simply call it the residual value. And so residual value is probably a little bit more descriptive of what's going on. The salvage value is used. Accountants will, well, I would dare say most accountants probably refer to that residual value as salvage. Whether or not that you like that term or not is really in the eye of the beholder. But in this case, we're saying that the depreciable basis is going to be 6,000. Now, we're sort of suggesting this is going to be straight line depreciation, and we're going to talk about this sort of practice and different means of depreciation and how straight line really is the most popular means by which to depreciate assets. For one reason, it's the easiest by far to work with. And all it really is simply cost minus residual over the estimated useful life. So in this case, 8,200 minus 2,200 is 6,000. That becomes the depreciable basis. Now, when we talk about basis, this is a term that we use a lot in the tax world, but it also has implications for financial accounting because the basis of something is the acquisition cost, the book value of that, but it doesn't mean that it's necessarily the depreciable basis because we're talking about, particularly in straight line depreciation, and we'll do some examples. We're not, we are going to get there. We have the residual value. We're not going to depreciate the residual value. We're going to depreciate down the residual value. And so 6,000 is going to be what we call the depreciable basis. The basis of the asset is going to be $8,200. And we're going to bring that basis down over time because of the fact that book value is declining. Okay. And again, I want to reiterate, and I've said this a gazillion times before, but it perhaps bears repeating the difference between book value and fair market value. Sometimes it's pretty extreme, and it does lead to maybe some misconceptions as to the value of assets generally, particularly when we talk about long-term assets. Short-term assets, I mean, it's not, I don't know that it's really even discussed in terms of fair market value, except maybe in the case of receivables and whatnot, where you're trying to transfer receivables to a factor or whatever. But I really, for the most part, it's a long-term asset concept where the fair market value may differ quite markedly from the book value. So in terms of measuring the allocation and in terms of where we come up with this depreciable time period, in other words, how do we allocate this cost and over what time period and who gets to decide? And this is a good question. This is not, there's no one size fits all here. There are guidelines, certainly in the tax world. They're absolutely, and first of all, in the tax world, we're sort of given a schedule. It's based upon what we call the clatter tables. I don't even want to get into what that is, but it's simply where we're told by the government, by the IRS, what we can depreciate over what time period, and based upon what we call convention, which we'll get into a little bit here a bit later. But when it comes to financial accounting, it's more of a best judgment. Accountants are sort of left to their own devices here in order to just establish what the useful service life is. Hopefully, they will consult people who are known to be familiar with this area. But it's an estimated use, and it's got to be accurate. I mean, if you're doing some wildly, if you're saying a delivery vehicle is going to last 100 years, that's no one's going to buy that, or even 50 years, no one's going to buy that. So if you're doing it in order to sort of slow down expense, because depreciation is expense, it reduces income on the income statement. So you can see where maybe this is subject to manipulation, but not so much. I don't think that the accounting world is that craven in that regard. But the service life has got to be something. It's an estimate. We really don't know. And some assets we think are going to last a fairly short time period just go on and on and on and on and on. And I certainly saw this in my career in banking, where we had a lot of machine tool companies that were my clients, that their machines were decades old. And when I say decades, I mean, we're talking about 50-year-old equipment that was perfectly good. It was just, these were big, huge, monolithic steel machines that just were, they were beasts, and they just kind of went on and on. But you can't, I don't know if anybody who's depreciating anything over 50 years, but you kind of get the idea that service life is estimated, and on the other hand, it could be an asset that doesn't last very long because maybe it's a crummy asset, or it's whatever. And trucking companies that have truckers who don't maintain their trucks as well as they should, they mess them up and don't service them and whatnot. So it's an estimate, and that's an important thing. The allocation base is simply what that cost that's going to be allocated over time. Remember, depreciation is an allocation method, taking that cost, which is a prepaid item, up front, and we're spreading it over the cost of the useful life, whatever that useful life is. And the method itself is really what we call the pattern. I like that term, pattern, in which the allocation base is expected to be consumed. When we talk about pattern here, we're talking about, is it going to be even? Is it going to be based upon some accelerated method? There are a couple of different accelerated methods we're going to talk about, where we take a disproportionate share early on and a less proportionate share later on in that service life period. And that's really what is going on with this idea of the allocation method. So pattern does not have to be uniform throughout the asset's useful life. There could be accelerated methods, but also we'll talk about a method that you probably covered in Principles 1, where we talk about the units of production method, which is for those assets for which depreciation really and truly is tied to activity, and activity is really the basis by which logically, not everything is logical in everyone's mind in accounting, but logically should be tied to the allocation of cost over time for that asset. Okay, service life, its amount of use that can be expressed in units of time or units of activity. This is really the two bases by which we depreciate assets. And we are talking about depreciation primarily here in this segment. So when we talk about the estimated service life of a truck, for instance, it can be in terms of years or in terms of number of miles driven that the company expects over the lifetime before that vehicle is going to be traded in or disposed of, or just simply trashed and whatever. And so for any depreciable asset, the physical life provides what we call the upper bound for the service life. Whether or not we take out salvage or residual value in the numerator divided by the years or units of production really depends upon the method we're going to use. And we are going to talk about this. This is an area where you really want to pay attention as to what is that basis, what we call the depreciable basis that we're depreciating. So you want to kind of make sure you're paying attention to that. And the physical life will vary according to what the purpose the asset is acquired for and the environment in which it is operated. So think about this. You've got a very high-tech piece of equipment, and you've acquired it, but all the technology that surrounds and is implicit in that asset is very cutting edge. And in 2 years, everyone's going to have that. So as a result, this thing is not going to be anywhere near as useful in 5 years, even though we depreciate over 5 years, as it is in the first 2 years. And so you may want to take an accelerated depreciation method based upon that recognition. Okay. On the other hand, something like a building. I mean, are you really wearing out a building faster over time in the early years as opposed to the later years? Or does the wearing out of that bill or the allocation of cost, and remember the allocation of cost is intended to be a reflection of actual physical economic activity. Is a building going to be used differently over long time periods? Maybe it is. I can't think of too many buildings, too many physical structures that we would depreciate on some of the basis other than straight line. Even tax accounting, which is really geared toward accelerated depreciation methods in general, does not allow for depreciation on an accelerated basis for real estate. That is the structures themselves. And so I think we have to kind of be aware of what the purpose and the environment which that asset operates. And so when we talk about the service life and the physical life, may not be quite the same, but they should be, one should be a reflection of the other. And the service life should bear some sort of connection to physical life. And your text has got a pretty good discussion of this whole thing. And when we talk about these are tangible assets, okay? And so remember, and I think I mentioned a second ago, that there are cases in which there's technological change happening. And so as a result, maybe these assets are depreciating much faster and going away much, much more quickly. And there was a very famous case back in the day when I was a grad student taking a tax course in which a company argued that the asset in question, it was a self-produced asset, which itself sort of made it a little bit complicated, but it was also extremely high tech, and they were arguing for a very accelerated depreciation method for tax purposes. And in the tax world, if you don't know what the asset is, if it's not defined in all these voluminous tables of assets, then it's going to be a 7-year depreciation. And the owners of the asset were saying, no way, 7 years is way too long. It's in 2 years, everyone's going to have this and whatnot. So, eventually went all the way to the district court, which agreed with the company that these assets are going to depreciate much, much, much more quickly. So mostly because of the fact that technological change makes some of these goods obsolete. Think about a 10-year-old computer. Would you really want to buy for a business a 10-year-old PC for your business? I mean, maybe, but I don't know, maybe not really. And what would be the useful life of that? I can't even tell you what we would do there. So these are tangible assets. Also, what does the management intend? Do we intend to use these assets? And what is the purpose of them? When it comes to intangibles, we've already talked a bit about intangible assets, where really the value of these is the legal existence of those of that asset. There's no physical substance per se, really. Whatever physical substance there is immaterial to the value of what that asset is. And so when it comes to tangible assets, we need to sort of link the service life to some sort of physical life that needs to make sense, with a caveat, of course, that there are issues of technological change. And by the way, how do we value it as we go forward? And one thing that we haven't really talked about, and I think it gets a lot of it's dismissed, I think, a lot by academic accountants, is the idea of how do we determine residual value? I mean, who's to say? I mean, we're talking about a property in 5 years is going to be worth X dollars. How do we know? I mean, 5 years is a long time. A lot of things can happen, right? If I buy a computer today, that computer may be completely garbage. I mean, I've got an old computer I bought in 1992. I mean, would not be able to put that to use. Even I tried to put it into use in a business and created a book value for it. I mean, how on earth could I estimate the residual value of that? Maybe that's an extreme example, but I think you get the idea. Who's to say what the residual value is? It's not as straightforward as what we might think. But again, I come back to the idea, a lot of these are estimates, and I think we have to understand that estimates are really a lot of what's going on in financial accounting. And this is sort of unsettling to a lot of people who think that, okay, accountants are simply recording data and we're bean counters, and that's it. Not really. We're making a lot of estimates based upon rational expectations of what's happening. So, all right, so we go to the allocation base. This is the amount that we're going to allocate over the service life. In other words, it's going to be mathematically, it's going to be the numerator, right? And it's going to be the initial value of the acquisition, which is, in a fancy way of saying cost, minus residual. And the residual is simply the amount expected to be received, minus any disposal costs that we're going to pay and whatnot. Again, everything here is an estimate. The only thing that's not really estimated is this. and that's the initial value at acquisition. We should know what we paid for something because that's, if it's an arm's length transaction, we should know what the value of that thing is. And so, but estimating residual can be very difficult. And I talked about this uncertainty about the future. So we really don't know. Sometimes, and what I have seen happen a lot is companies will simply say it's going to be zero. We're not even going to pretend there's going to be a residual value. And by the way, they may want to do that. And in tax accounting, there really is no residual value that's placed on it because, who knows, and who knows what's going to happen. And a lot of tax policy really sort of benefits businesses in this case because it allows them bigger write-offs. And there are a lot of other issues as well. I don't want to bring in too much in tax here, but I do think it's important for any accountant to understand that there are differences in depreciation between book accounting, which is GAAP, and tax accounting. And in tax accounting, we really don't have residual value. And by the way, even in financial accounting, sometimes companies will say, we have no idea what it's going to be worth, and we're just going to assume it's going to be zero. And that's fine. And if you want to say zero, it means you take a bigger write-off. It means you lower your depreciation expense annually until that asset leaves the books for whatever reason. In other words, it's disposed of, but it's not uncommon at all. And in fact, I think it may be even a little bit more honest, frankly, to users to say, we don't really think this asset's going to be worth anything whatsoever. I mean, when you buy a car, I hate to mix metaphors here, people's family cars and something like an 18-wheeler, but when you buy a car and you expect to pay it off and own it for 10 years, do you really expect at the end of the day, in 10 years, that car is going to be worth much more than, I don't know, a few $100s or whatever, which may be a tiny fraction of the original acquisition cost and all that. Maybe you do, I don't know, but for the most part, I think the assumption of zero is not at all illogical at all. Okay, so I sort of underline that, and sometimes I'll underline things that I think are particularly salient examples of what we're trying to communicate. The method itself. So we go back to here this issue of pattern and how we depreciate it. So we're gonna choose that method which corresponds to the pattern of benefits. Okay, this is important. If it's uniform over time, for the most part, maybe a time-based method is going to be necessary. Certainly in the case of real estate, I don't know that most real estate depreciates faster or slower with different usages or whatnot. I mean, it could, I suppose, but a time-based method would seem to be would be indicated there. Activity on something which is there's a lot of volatility in terms of usage. Vehicles, ships, planes, some machinery that is, maybe idle for a time, particularly since there are some industries that are exceptionally susceptible to cyclical downturns or boom cycles and whatnot. So maybe an activity-based method might be used there. So the method is really the pattern of benefits. And I think it's probably under GAAP accounting, what we're trying to do is we're trying to choose the method that is, and here's the quote from FASB itself, as equity as possible for the periods during which services are obtained from its use. Remember, an asset has future service value, and so there are some benefits that are enjoyed over time, mostly evenly, and there are some that are mostly uneven. And as a result, the method itself or the pattern of allocation is really dependent upon what the kind of asset is. And so, again, some assets, and I come back to real estate because it seems like an obvious one where it's going to be more a uniform usage of the asset over time. And so we might pick a straight line method in terms of cost allocation. Okay. All right. Let's move on here. So here's a quick quiz. The process of cost allocation requires that three factors be established at the time the asset's put into use. This includes all of the following except service life, finance charge. Well, we haven't even discussed finance charge, the interest cost. That's not even something we've gotten into. That's an easy one. Allocation base, we've talked about. That's the depreciable basis. Allocation method, which is the pattern. It's got to be B. That's a pretty easy one. Too easy question, right? So that's one we can dispose of. So, but I do kind of like these little intermediate questions here. So, all right, let's talk about depreciation. Now, here we are talking about depreciation of tangible assets, sometimes called fixed assets, not because they're fixed in place, but because they're fixed on the books for a period of years. And so we're allocating these, the depreciable basis over time using either straight line or a number of accelerating methods. And we talk about straight line, it's far and away the most commonly used method of depreciation for financial accounting. And one reason why it's popular is because it's easy to employ. And here we get to the idea, and I know that as long as I've been teaching, the students will say, well, we put an asset on the books and, the computers will depreciate this thing over time. We don't even have to do it, right? And that's true. Software will depreciate these assets if they're based upon straight line at the time of acquisition, that they will depreciate them over time. But again, we come back to this idea of what if you have to explain something to someone, a boss, or if you're in public accounting to a client, how do we get to these methods? And I mean, I really think this is important, particularly for those who are looking to go into public accounting. We've got to describe to clients how we got the depreciation method, if they had questions. Now, I don't know that straight line is going to raise as many questions as the accelerated methods, but nonetheless, what I'm trying to do is sort of address the argument that the software will do it all. And I know that a lot of accounting profs have this preference for people doing things by hand, and I understand that, and I think that it's a good thing. I certainly do in my business math courses where I want people to sort of do things by hand, just to sort of see how the pieces fit together. But nonetheless, straight line is used in practice because it's fairly easy to deal with, and it's not very controversial. No one's really going to, I don't think, argue about a straight line method. Accelerating methods are where we got a different method where, when we say accelerated, what are we doing? We're taking more depreciation up front and less at the end for a lot of different reasons. Now, as commonly is used as straight line depreciation, accelerated methods may have a lot of logic, and that is particularly in assets in which the technology is fairly new and it's not going to be worth as much in 3 years as it is today. So on a 5-year depreciation schedule, maybe we want to take the most of the allocation, in other words, the cost allocation in the early years, because of the fact that it's going to not be as worth as much. And so that's one of the bits of rationale for an accelerated method. Higher depreciation up front and lower depreciation in later years. And by the way, here I do want to separate ourselves from tax depreciation, where there are cases in which companies can write off the entire thing for tax purposes up front, and those numbers have gone way, way up in the last few years. And we're talking about financial accounting here primarily. I do bring up tax when it has a particular relevance and linkage back to financial accounting, but for the most part, we're not getting into that. We're talking simply about the logic of taking a greater amount of depreciation in the early years and less in the later years. Okay. When we talk about this, double declining balance is really far and away the most popular there, and we simply take the straight line rate times 2, which is why it's called declining balance, double declining balance, and we simply depreciate it from there. In all cases, we're depreciating the book or the asset down to its residual value, if there is a residual value, and we're going to stop depreciating it, and we'll see some examples of that. There's also something called sum of the year's digits, and where it takes the depreciable base, and it's also a declining fraction, and we'll see an example of that. This is one I will tell you, I think it's entirely possible. For those of you who are going to be professional accountants, it's entirely possible you can live your entire career without ever seeing a sum of the year's digits method being employed. It's just simply a different way of stacking early depreciation and based upon just simply a mathematical methodology. And remember, intermediate accounting is sort of geared around the idea of applying methods, different methods. There's not one way to do things. There's 2 ways and 3 ways. This is an example of just another way of doing it. And by the way, if you have a financial calculator, and the cost of these have come way down over the years, you might see on a financial calculator S/L for straight line, or DDB for double declining balance, or SOYD. And those are simply ways that you can simply plug it in to a calculator in order to get the answer. And so, if you are going to go into finance in particular, you may want to look at those, but I don't know that I've used those a lot. But there are methods, there are simply tools that are out there on financial calculators. I think I pay like $20 like for my most recent one. It's an HP and it does pretty much everything I want to do. So, and then there are also, so these are both time-based depreciation methods, okay? They both have a time element as a denominator, and we'll get to the math here in a second. And then there's activity-based depreciation. And what we're talking primarily here about is what's called the units of production method, where we're saying up front, as we acquire the asset, we expect to get X amount of units of output from this particular asset, whatever it is, whether it's a machine that's going to, spit out, 20 million pieces of gum over the years, or whatever, or I mean, one of the things I can tell you, my experience, trucking companies will use units of production method because their volume is quite dependent upon activity level, and if a truck isn't moving, it's not theoretically depreciating. These are really long-term assets, and so you may say, okay, an 18-wheeler is going to get 1 million miles over its useful life, and obviously you can do things like change an engine and whatnot, in which case that would be an improvement. We would step up the depreciable basis once again for that. But nonetheless, you get the idea that you're not going to do 100,000 in 1 year, then do 2,000 the next year or whatever. And in which case that depreciation method may make sense. In fact, it does a better job of matching expenses with the revenues that are associated with that particular asset. So there's a lot to be said for it. It may not be practical in all cases. I cannot imagine that furniture would have any kind of usage. I mean, how on earth would you measure usage of furniture or fixtures or even computers and certainly buildings? I mean, there are a lot of assets where this does not really apply. But things like trucks and aircraft and I don't know, maybe locomotives. I mean, the list probably goes on and on. But there are a lot of examples in which this may be a more accurate means of cost allocation. Okay, so that's one of, and we're going to get to some examples here. So hopefully, before we leave today, we're going to do some examples and we'll show what's going on. So, all right. So let's take the first example we're going to look at. And that's the straight line method. So, and I think this example goes on here for a bit of time in this. So at the beginning of year one, Hogan Manufacturing bought a machine for $250,000. All right, so that's the cost. So we book it on the asset side, debit balance equipment, $250,000 or machine or whatever. It's got an estimated residual of $40,000. That's estimated. Again, an estimated service life. Again, the word estimated keeps coming up again and again. We don't really know, but it's an estimate. So estimated service life of 5 years, estimated production of 140,000 units. Well, not all these facts are going to apply depending upon what method we're going to use, right? So obviously, if it's straight line, you're not looking at the units of production, but we're going to sort of apply these facts to the various methods we're going to be using. So, all right, so and this is and by the way, 140,000 units is sort of spread out over this sort of method right here. Okay, actually, it should be 150. It looks like, right? For whatever reason, they didn't really adjust that. So I think it's 140. I think the math is 140. But all right. So anyway, here's the straight line method, and this is something you ought to kind of lock in. And once you know it, it's I know a lot of things in accounting and math. If you don't use it, you lose it. This is something you should not lose, and that is, what is straight line depreciation? It's cost minus salvage or residual over the estimated useful life. So 250 minus 40 is going to be 210. Over 5 years is going to be 42,000 a year. That is, for every full year, you're going to be taking $42,000 a year depreciation expense, meaning you're going to have a debit to depreciation expense and a credit to accumulated depreciation to record that it's an adjusting entry that you're going to do. And I say full year because if you bought it in July, say July 1st, it's going to be 1/2 of that period. So it's going to be 21,000 of that first year. And you're going to start the 5-year clock at the date of acquisition. And you might say, well, okay, it's always nice that we have January the 1st and July 1st and December 31st. In reality, are we going to land on those dates? Well, usually what financial accountants will do is if they acquire an asset between the 1st and 15th of any month, they will account for the full month. Anything after that is going to be into the next month, and that's just sort of the convention that is used. And so, I mean, in the end, I don't know that. I mean, over long time periods, does it really matter? What day of the month we bought something, or even what month of the year. I mean, I guess over the long period. If it's a very expensive asset, maybe it does, but we do want to allocate that for odd number of months. And I think a lot of examples that you'll see in homework and quiz are based upon not the idea of buying a vehicle on New Year's Day, which is probably unlikely, and selling it on New Year's Eve the next year, which is probably equally unlikely. That there are different times throughout the year, but straight line makes it very, very easy, and so there's really no difficulty involved with that at all. And again, if we're talking about straight line, we really don't care about units of production because we're not based. This is a time-based method, not an activity-based method. So let's take a look at this. So here's the straight line for this asset in question. 210,000 is depreciable basis, and so we're saying every year it's a 5-year depreciation schedule, and it was purchased on January the 1st. Was it January 1st? I think it was. Yeah, the beginning of the year. Okay. It's going to be 1/5 of the depreciable basis, which is, again, cost minus residual. 250 minus 40 is 210 divided by 5, or 1/5 per year is 42,000. So what are we doing here? Let's follow this because this is important. And this is something that this just looks like a homework problem in Connect. And so keep in mind the depreciable basis is going to be fixed and constant throughout, which is, again, is one of the arguments for straight lines is its simplicity. So 210 times 1/5, or 0.2 if you want to go with the decimals, you get 42,000. And then as the accumulated depreciation, remember, depreciation is a debit, depreciation expense is a debit, accumulated depreciation is a credit, but you're going to reduce the book value by, not by depreciable basis, but by, remember, the book value was the acquisition price, 250. 250 minus 42 is 208, okay? Now, we don't really care about that, other than the fact this is going down over time. And I shouldn't say we don't care, but this doesn't do much other than lower that book value. And all it is, it would simply be on the balance sheet, machine 250, accumulated depreciation 42, and then sometimes there's a separate line item for net, a machine or net equipment or whatever. But that's what's going on there. So every year, the same thing, 42, 42, 42, all the way down. To the point where we're picking up, we're accumulating depreciation. Remember, this contra asset accumulates these expenses which reduce the value, the book value of the asset to which it refers. If it's contra asset, it's going to reverse and reduce the value of the asset in question. So it's going to be 42 to 84 to 126 to 168. Now, notice in year 5 what's going on. We're depreciating this all the way down now. And because we already set up the residual basis, we're going to depreciate all the way down to 40,000, okay? And this is one method in which we don't have to do a lot of fancy dancing or any sort of human intervention in terms of the adjusting entry. It will simply do it itself. And because of the fact we bought at the beginning of the year, it makes the math extremely easy, but that's really what's going on. So all we're doing is we're simply reducing the book value of the asset all the way down to its residual. And by the way, this residual may or may not be correct. And furthermore, maybe this asset will live another 10 years, right? I mean, there are assets out there, and this is one of the things that is not often talked about, but very old firms, they have very reliable and well-maintained assets. Sometimes these assets are mostly depreciated off the books, and this is where fair value accounting really does apply, particularly if you're looking to exchange assets or sell your company. You got to sort of make clear that the book value is not really a good reflection. Book value is what it is, and it's simply allocating a cost over time. And sometimes these assets can go on and on and on and on. And I certainly see that in my experience with companies have assets that really, from a fair market value standpoint, far exceed what's being carried on the books. But yeah, if there's no offer to sell those assets, it really is mostly immaterial. But from an operational standpoint, they still have service value in the sense that they still create value. And if an asset doesn't create value, then why have the asset in the first place? And so that's something to think about. So this is the straight line method, far and away the easiest method to use, which explains one reason why it's used pretty frequently throughout the business world. And so, example, a machine that costs 160 has an expected service life of 8 years and a residual value of 16,000. depreciation for the second year of the asset's life is going to be what? Well, it's going to be 160 minus 16, which is going to be 144. And over the time period, it's simply divided by 8. Now, there's a reason a lot of these examples are going to be second year, because there are some initial things going on in the first year that may not be as germane, and we want to pick up accumulated depreciation in the first year. But in this case, we're simply saying in the second year, because maybe we bought it in August or whatever, we know that the second year of an 8-year life, it's going to be a full year of depreciation. It's going to be 144, which is cost minus residual divided by 8. It's going to be 18,000. So that's going to be the third year. It's going to be the fourth year and fifth year. As long as that asset is still on the books. Now, we will talk about disposition in the sense that, okay, at the end of 4 years, maybe this asset, we no longer like it. We want to get rid of it. Well, we've talked a bit about that already, right? Where we can simply dispose of the asset, and whatever the exchange value is the fair market value, and its relationship to the book value, cost minus accumulated depreciation, is recorded as either a gain or a loss. We got into that in a bit in chapter 10. We are not locked into an 8-year time period here. I mean, you're free to do whatever you want with the asset you named that, right? So, and go from there. Okay. All right. So that's an example. One of the quick concept checks here. Let's talk about the accelerated methods here. And again, this is still a time-based method. This is not an activity-based method. We're talking about an accelerated method. Most common, I think, by far, is going to be double declining balance. And notice here, the depreciation base is the acquisition cost, what we call basis, and we do not deduct the salvage value. We don't deduct the salvage value, and that's just something different. And which, by the way, aligns. I keep coming back to tax accounting, but we don't use salvage or residual in tax accounting typically for the accelerated methods. And by the way, most depreciation methods outside of real estate. And we're not talking about depletion or amortization, but depreciation for tax purposes, business tax purposes, is mostly based on this method here, what we call DDB, double declining balance. And that system from tax, in the tax world, is called MACRS, which is a fancy acronym that stands for Modified Accelerated Cost Recovery System. So, if you want to sound smart, looking for an accounting job, make sure you know what MACRS is, even if you don't work with it very much. If you take part of my tax accounting course, Corporate Tax 2350, we talk a lot about MACRS and what MACRS is about. It's basically this. There's an issue with going into the asset, what we call convention. Let's put that to the side. We'll come back to it. So what's really going on here is we're adjusting the depreciable basis every year. The book value is declining, and it becomes a new depreciable basis. That's something we don't do in straight line. Now here's the thing I should mention, and this is, I guess the good news for you is that all these activities are open book, and so you can always say, okay, and I don't know that you need to memorize these. I mean, it would be helpful if you did, but I don't expect everyone to memorize them. But if you refer back to your text and to examples, and by the way, there are so many examples of things out there in the world that you can look at to get examples that you can see for yourself and sort of supplement your knowledge. So you don't really have to memorize it, but just know that with double declining balance is going to be based upon a declining, not just a depreciable basis, but a declining book value. So in this case, the residual value, we don't really care about, other than the fact that we're only going to depreciate the asset down to its residual. This is where this is what we have in common with all these depreciation methods, is we're going to bring the book value at the end of that life. These time-based systems, we're going to bring it down to 40,000, and we're going to stop there because that's the estimated residual value. Now, I think we come back. I think later in the chapter we talk about, hey, what if the residual value is wrong and we need to adjust that? We can do that. We can make the adjustment, and we don't go back and recreate history. We just simply start with the new set of facts where we've determined maybe the residual is not 40, it's 20, or it's 60, or whatever, and we'll start from those facts there. So again, accountants are not so stubborn as to say, "Wow, this is what we decided at the beginning of this 5-year period. We're going to stick with it, right or wrong." Well, no, it's not right or wrong. We want to be right, and to the best of our knowledge. And again, the load is estimated. So let's take a look at what we're doing here. $250,000 is the cost of this machine over 5 years. Now, let me flip back here because remember, under straight line, we said 5 years. Okay, that's 20% per year or 1/5, right? Right. I would prefer they use decimals here, but 1/5 or 20%. Here we're simply amping that up and saying it's going to be 40% a year. So we're stepping up the amount of depreciation. Okay. So 250 times 40,000 is going to be 40%. I mean, is 100,000. So debit depreciation of 100,000, accumulated depreciation is the credit for 100,000. So we're reducing the book value. 250 minus 100 is 150. That becomes the new depreciable basis as we go to the next year. 150 times the same percentage, which is double the rate, which is why we call it double declining. 150 divided by 40% is 60,000. So we're going to debit depreciation expense 60, and we're going to credit accumulated depreciation 60, which takes that balance from 100 to 160, and we're going to reduce the value then to the book value or the carrying value. Book value is also sometimes known as carrying value at 90,000. This is the end of year 2. We go to year 3. It's that same book value times 40%, 36,000, and we go on, and we're reducing the book value to 54,000. Notice in the 4th year, right? We don't even get to the 5th year because we're accelerating the depreciation, right? And so we're saying 54,000 is the depreciable basis for that 4th year. But if we take that times 40%, we're going to get some big number that's going to bring the book value below the salvage or residual value. So we're only going to take out 14,000. That's why it's in red here, in order to bring the accumulated depreciation, 210, down to its depreciable basis that is cost minus salvage or residual. And so we're going to bring it down the carrying value of 40,000. So this is obviously a lot less. Now the numbers come down, and that's by design. That's why we're stepping up the amount of depreciation expense with double declining balance, right? And again, it sounds like, maybe this is it's kind of a quirky way of doing it, but it's very much used, and certainly in tax accounting, it's used predominantly for the depreciation of fixed assets outside of real estate. Real estate's primarily still straight line, mostly because I think nobody buys the idea of accelerated usage and allocation in early years, as it would be in the case of equipment, particularly technology. But it's and there's some other things going on with tax accounting that make it, to incentivize producers to acquire assets and whatnot. But here we're simply we're bringing the early depreciation 100,000. That's a pretty big amount out of a $250,000 value, the depreciation is going to decline rapidly, but we're taking most of that up front. And that's what double declining balance is. This is one of the what we call accelerated depreciation methods, and it's very commonly used. And a company might use it for GAAP purposes, not just for tax purposes, simply because of this idea that maybe an asset's got much more productivity in the early years as opposed to the later years. Sometimes assets are very productive early on, and they just sort of lose their oomph, their ability to produce, and so it may make sense to do that. So, okay. All right, so that's one method of accelerated depreciation. Again, we're into the time-based methods of depreciation here. We've not gotten into depletion or amortization. As I mentioned at the outset, we're not going to get to that here, but we are going to talk mostly about depreciation here. That is depreciation of what we call depreciable assets. So another method is what's called sum of the years digits. And this is kind of a quirky system where we're simply saying, okay, we have an asset, same facts, right? We're just simply, we've gone from straight line to DDB to now sum of the years depreciation, or sum of the years digits, which is a form of accelerated depreciation. And all you're really doing is sort of a mathematical quirkiness where you're saying, okay, it's a 5-year property, right? And what we're simply saying is, if it's got an estimated residual value of 40,000, we're still going to take it down to the residual, even though it may not be what would ordinarily mathematically be the case. And the depreciable base is going to be the same. It's a little bit different than double declining balance, where it's still cost minus salvage. This is where some of the years digits looks a little in the numerator part of the annual depreciation calculation, which, by the way, is an adjusting entry. It's got to be done. It's not something that your software can do it. If software doesn't do it, if you're doing it by hand, you got to do it as a process. But it's the very same thing here. But we're saying we're simply adding up the digits. 5 years: 1 plus 2 plus 3 plus 4 plus 5 plus 15. Okay. And because it's 5 years, we simply, that's the denominator in every case, right? 1 plus 2 is 3, 3 plus 3 is 6, 6 plus 4 is 10, 10 plus 5 is 15. That's how we got 15. Some of the digits, right? It's a lot like if you're familiar with what's called the rule of 78 accounting system, where you take, usually on loan interest, 1 plus 2 all the way up to 12, you get 78. You kind of do the same methodology, but it's a way of stacking early and accelerated expense in the early years. And so in this case, we simply go 5, 4, 3, 2, 1, right? Remember the denominator is the same, it's 15, some of these digits, but we go 5, 4, 3, 2, 1. So 210, which is cost minus residual times 5/15 or 1/3, you're going to get $70,000. Same accounting, debit depreciation expense, credit accumulation, accumulated depreciation, and we bring book value down, not from the depreciable base, but from the cost, right? Which is the book value. The book value does not, you're going to put all assets are booked at cost and are going to stay there. Now we were going to pick up a contrast of accumulated depreciation. But how would we reduce book value? 250 minus 70 is going to bring us to 180, right? And the book value is going to go down. It's going to stop at 40,000. But we start in the second year, the same deal. We're assuming full years that are going on here. So 210 times 4/15. I have no idea what the decimal is. I think it's maybe, I don't know, whatever it is. It's going to be 56,000, which is going to add the accumulated depreciation. And I'm going to subtract that from the book value of 180 to get to 124. We're going to go on for year 3, year 2, and then year 1, we're still going to depreciate it down to its book value at the end of year 5 here. Okay. And again, the assets still may have useful life. The business facts haven't changed. The economic events are not different. It's just the way that we allocate the cost, which is what we call depreciation, over long time periods varies. And so this is just another variation. It's just another variant. And we don't take the salvage value out, but we still depreciate it down to its salvage value. Okay, so it's the same deal as what we had in the previous example in terms of depreciating it down. All it is simply one variation of it. And as I said a bit ago, I don't know that you're going to see this a lot. You may. I think it's a little bit tricky and kind of maybe too cute, but it is one method that's used. Okay. All right. So that's some of the year's depreciation, and that's another method by which we acquire or we allocate cost over time periods. So a quick balance check here is a machine that costs $160 has an expected service life of 8 years and a residual value of $16,000. Depreciation for the second year using the double declining balance method as well. Okay, so we're going to go back now to the double declining, not some of the year's digits. And so what's going on is this. Well, first of all, we have to do, there's a reason why they do this, the year 2, is because we have to do year 1 first, right? So we're taking 160. Remember, in double declining, and this is just something you've got to use and refer back to your text, have your text available when you're doing homework and quiz. This is one method that we have where we specifically do not take out salvage from the depreciable basis. And so it's 160 times 25%, right? And where did that come from? Well, it's twice 1/8, right? 1/8 is 12.5%, right? 8 years. We're stepping at that percentage. 12.5% times 2 is 25%. So 40,000 comes out of that, right? So we take, and we do adjust the depreciable basis every year in double decline. So 160 minus 40 is going to be 120 times 25% is 30,000. That becomes the answer for the second year depreciation method. So you got to kind of do a little bit of work there in order to sort of back your way into it. But this is one that I would suspect is a pretty commonly favored method of assessment in the connected system. So, okay. All right, so that's example. And so we're talking about methods where we're taking a time-based method and we're sort of applying it. And now let's get into activity-based methods. Again, not every asset is going to be appropriately allocated cost-wise, depreciation-wise this way. And I think that we go back to this idea that FASB said, what is the most appropriate method based upon what makes sense for how the asset is used. Okay, some assets are used a lot in some periods, particularly in very volatile industries, very cyclical industries, macroeconomically cyclical, where you've got oil drilling equipment. Price of oil is really high. Everyone's drilling like crazy. It's running 24/7 for months or weeks, and suddenly the price of oil falls for whatever reason, and it doesn't do anything. It's not used, or maybe only a very small amount. So that would be an example. Obviously, the example of trucks makes a big sense. Trucking is such a huge industry. We all see trucks every day, right? Going to work, and maybe we don't even think about the fact these are being depreciated somehow. How are we doing it? We can straight line it, and it's perfectly acceptable to straight line depreciation, right? But maybe activity-based methods may make more sense, particularly if you're interested in the accounting concept of matching, where you're trying to match up the expenses incurred with the actual revenues generated. And so this is probably the best way of all. Now, is it easy to use? Well, it may be, particularly when it comes to mileage of trucks. I don't know if that's all that difficult. Someone's got to do the accounting for that and the bookkeeping for that. It's got to be recorded, but that may not be as onerous as what you might expect. Truckers do keep logs. I know that we've heard about truckers using 2 logs and whatnot, but let's not get on that can of worms. All we're simply saying is it may make more sense to depreciate something based upon its actual usage, even though we're going to establish a service, an estimated life of that. And sometimes these assets may last that service life, and sometimes they may not. And when they do or whether they don't, we have a way of doing the accounting treatment for that, which is everything surrounding disposition. So, all right. So in this case, we're talking about the usage of the goods. So at the beginning of year 1, Hogan Manufacturing purchases a machine for $250,000. And by the way, it's not just vehicles. I know I sort of focused on 18-wheelers and 737s and whatnot. It could be any kind of machine that we have a reasonable expectation is going to be used, particularly more or less over time periods. And this is sometimes used in backup machinery, right? Where backup machinery, really, is maybe older, maybe it's not as valuable, but it's a backup piece of equipment, and we'll depreciate that asset, this individual asset, over using a activity-based method. That may make a lot of sense. It may make a lot of sense, because if we don't use something, and I'm presuming that machinery doesn't tend to get stale or expire, then that may make sense. So you can use different methods for different assets, and it's perfectly acceptable as long as you disclose what's happening and it makes sense and you're following the GAAP principle. So, all right, back to our Hogan example. Beginning of year 1, they bought a machine for $250,000. Same, all the facts as before. Same residual, same estimated useful life, same production method. Here we are concerned about the units produced here. So 20 plus 32 is 52. 96. I guess maybe there's 150. Right. So these are the units being produced there. I think one of the slides had 2 different numbers, and so those are the units that we expect this asset at the time of acquisition to be able to produce over its useful life, which we're saying is 5 years. Now, again, we could change our estimate over time. Maybe 2 years down the road, we say, "Man, this thing is going great. We're going to expand the number of units that it could possibly do." And that's fine. We do that. We don't go back and restate financial statements, but we just simply say, "All right, going forward, we're going to make these changes once we recognize." Or we say, "Hey, this asset is not what we thought it was going to be, and so as a result, we're not exactly as enamored with it as we were before." We can make that change as well. All right, so after this example, so here's the allocation of units over the 5-year expectation. And let's just say this is what actually happens. And we're going to arrive at $1.50 per unit. That's cost minus salvage. Again, that's not unlike the straight line numerator, only it's not based upon years, it's based upon units of production, which is going to be 140. They keep going between 140 and 150 here. I don't know why they keep doing that, but I think these things are I should have brought my calculator. I should do the math, but sometimes these are edited and whatnot. But anyway, the bottom line is if you do 250 minus 40 divided by 1, I think it's going to be $1.50 per unit. I think I did the math as I was preparing for this, and I did realize that they've got different numbers. And it's irritating when there are errors in this, and I apologize, but it's kind of the way it is. And so Here's the expectation, 20,000 units in the first year. Times $1.50 is 30,000. So debit depreciation, credit accumulated depreciation. We bring the book value down from 250 to 220. Notice this is down even. This is not straight line because these numbers are all over the place. 20,000, 32, 44, 28, 26. They're all over the place. And so it's as we're still going to depreciate it down to its residual value, but it's going to be on quite a variable schedule. Because and by the way, we don't really know. I mean, how on earth can we know what's going to happen in the next 5 years in terms of activity? This is an activity-based method. We don't really know. I mean, it's based upon sales and a lot of different factors. But if we employ this method, we take the actual units produced or miles driven or hours operated, whatever the case might be, times this constant amount, which could change if we change this estimate, but we're assuming it's not changing. And so we're going to get 48,000 the next year, 66,042. And we're going to bring it down. And the final bit is just to depreciate it down to 40,000. And that's what units of production method is really based upon. It's based upon activity. And as a result, it's going to be quite variable. We don't always really know what's going on here. Again, the numerator is identical to straight line, but the denominator is an activity-based measure, not one at a time. Okay. And I will say, and I know your text gets in this a little bit later when we sort of evaluate do a comparison of these different methods we used here, that the units of activity is probably a better match in terms of what we call the matching concept of matching revenues and expenses in the same particular period. But it's not nearly as commonly used. It does require some bookkeeping and whatnot, but this is where it gets back to management. And again, we have to this is a business school, so we do talk about the role of management. We have to track this stuff if we want to use this particular method, and we have to sort of do the proper accounting. This is where good record keeping comes into play, and it's not so much paperwork as it is just simply making some recording somewhere so that we know what the actual numbers are that we're going to apply to the depreciation unit for that accounting period. Okay. All right. So any questions about the units of depreciation method? That's the only one that we're really going to get into here with regard to what we call activity-based measures. And what I like this sort of comparison here. This is also in your text, but it sort of lays out the differences in which we simply allocate the cost of the asset, the long-term asset, over time periods. Of straight lines, even, boom, we're assuming full years here, right? So 42,000 units, easy peasy. We're depreciating it down to the book value or the cost minus salvage at 210 or residual. Double declining, we take a lot more up front and a lot less in the beginning or the end. As a result, we're still going to bring it down. The book value is still going to be 210, and the same with some of the years, the units of production. We're going to bring it down to the estimated book value. This is depreciation I'm talking about. We're going to bring it down, everything except for the residual value. Some of the years digits, again, it's an accelerated method. It goes down, down, down because we take the early depreciation early on, right? The majority of it, and a far less number at the end. And the units of production is just all over the place, and we could be, where. And by the way, we may not even use the 140,000 units or whatnot. So, in which case, we have to do sort of a recalculation of what our estimated useful life is and whatnot. So these are things that are done. They're done fairly frequently. This is why accountants have an important role to play. That is, how do we recalculate? How do we reallocate these things over time once new facts come in? So whether it's an extension on the useful life or the overall productivity of an asset, or whether it's in a case where the asset itself is what we call impaired. We're going to talk about impairments either Thursday or next week. I did one. There's a reason why I sort of deferred this particular chapter segments activities until next week, is because we have a lot to do still. So we're going to talk more about this on Thursday. We're also going to get into more of this as we get toward the very end on Tuesday next week. So I do want to spend the amount of time that we need to make. So, all right. So when it comes to selecting a method, straight line's easy. We talked about that. I think we've sort of beaten that dead horse. It also results in less depreciation in the early years compared to accelerated methods. And as a result, it's got a positive effect on net income in the early years. This is one of the downsides to accelerated depreciation is the idea you're picking up depreciation is the expense, which lowers net income, obviously. So if you're using an accelerated method in the early years, you're going to you're going to understate net income because you're overstating relative to the straight line, that is, net income. Why? Because you're overstating depreciation expense and therefore understating net income in the early years. And the opposite flips in the later years where you're understating expense and overstating net income. All facts remain the same compared to straight line, which is an even allocation over a time period. So you have to kind of understand there are net income effects that are going on there. So now in tax accounting, that's what you want. You would want to reduce your taxable income. And so, far from the tax code always being punitive, sometimes it really rewards businesses in particular by allowing them to take a lot of depreciation up front. So they pay less tax in the early years. And there's a public policy motivation there. We want businesses to buy assets, and so that's a motivating factor there. So that's something to think about. Okay, and this is notwithstanding any of these super accelerated methods, like what we call bonus depreciation. That's something separate we're not going to get into here, but it's the same concept though. All right, so we talked about this, and the tax benefits are one we can't deny. I don't like the LIFO conformity rule though, and remember we go back to a few weeks ago. We talked about LIFO methods, and we said that LIFO is used, even though it's a pain to work with, and it's really one of the more challenging areas of work, I think, in financial accounting. It's a pain because it overstates expenses in the later years because you're assuming you're buying the more expensive, most recently acquired inventory. So if you're going to use LIFO for tax purposes to lower your taxable income, the LIFO conformity rule under GAAP requires that you also use it for GAAP, so you're reporting to external users the same number. The same does not apply with depreciation. That is not the case at all. You can use straight line depreciation for book purposes or units of activity, whatever, but use accelerated methods for tax purposes. There is no uniformity rule there. So, and by the way, this brings us back to this longstanding issue of the fact that tax and GAAP are not the same thing at all. The only thing that sort of remotely links the two systems together in this case is the double declining balance method that's used, which is an accelerated depreciation method, which is what the maker's system, modified accelerated cost recovery system, seeks to use. Okay, so and then one final thing here, and we'll talk about this. So it's differences between IFRS and GAAP. Now these are pretty significant differences, and it's really interesting. Number one, under GAAP, we use what we call component depreciation, and it's not often used. This is the case where you've got an asset's got multiple pieces that depreciate at different rates. Okay, and this is maybe more of an advanced accounting concept, what we call composite depreciation. Take something like a cell phone tower, where the tower itself may have a 50-year useful life for 30 years or whatever, but you've got individual electronic components that may have a 5-year or 10-year life. Well, are you going to depreciate every component individually? Under IFRS, yes, you would do that. That's what's required. Here, maybe it's not used often in practice because there are not a lot of assets that have these different amounts of depreciation. Old school example is a telephone pole where you got a big long piece of wood that's going to last for who knows 100 years, right? And then you have these electronic items that are going to depreciate slowly, but it is one asset. It's a telephone pole, right? So you could do it, and what we call composite depreciation under IFRS, they've got to be depreciated separately if the cost is significant in relation to the total cost. Here, the depreciation basis is simply taking the residual value out. Here, we're going to take out the residual value, but we're going to review that at least annually. And by the way, this idea of annual review of fixed assets is something that IFRS, the International Accounting Standards Board, really stresses, particularly, and they're very big on impairments too. They want to make sure that you're marking down assets if those assets have become impaired for whatever reason. And we do the same thing here, but the International Accounting Standards Board, under the IFRS standards, is much more vigilant on this area. And the tests are a little bit different. They're slightly different, not hugely, but the testing methods are different. If we really are interested in international standards, you can take an international accounting course. What we're trying to do is to emphasize that there are some differences, because multinational companies will have to do both of these. If you're doing business here, you're going to do business with GAAP. Everywhere else, pretty much everywhere else, IFRS. And the methods used are various methods. Here, you can use the same amount. It's called diminishing balance, not declining balance. And what that is something we're not really going to cover here. But those are the differences that we want to talk about between the GAAP standards and the international standards. And so our purpose is not to really get into that in great detail, other than to note the fact that there are differences that I think should be noted. So in practice, if you're faced with those, you'll just have to look into the standards and find out what's going on. Nobody can remember all this stuff, and that's the thing. I think we ought to know that there's a lot of things to know, and so resource materials is often cited. So I've yet to see anybody who knows every single principle about every single thing, and so and some things you don't use all the time, and so you got to go look at it and find out what's going on. So okay, so questions before I'm a little bit over. I apologize for that. So I'll go ahead and post this video for those who are going to watch it asynchronously. And if you have questions, feel free to get with me. When we come back on Thursday, we'll talk a bit more about some different methods of allocation. We're eventually going to work our way to other assets, particularly intangibles, before we leave this. Okay. All right. Have a great rest of your day. See you next time.